Money, the whole world's favorite point of discussion. As we all know, money is important. It is our basic unit of exchange. But too much money, well, that is not so good. I know, Bill Gates completely disagrees, obviously, but let us not look at it unilaterally. The fact is that, when it comes to money, the most consistently sensible adage after "cut your coat according to your cloth" is "too much of anything is bad for you." Every country in the world agrees on this. If there is too much money in circulation, inflation will happen. But that is not the only way inflation can occur. In economic terms, inflation is the rate at which the prices for goods and services rise in a country. Depending on varying, sometimes uncontrollable factors, inflation can rise and fall rapidly. Sometimes these factors are the economic conditions and measures a government chooses to control or counteract the inflation. Inflation is connected to the economic principles of supply and demand and can be viewed positively or negatively depending on the specific situation and the rate of change. Yes, you heard that right. There are two sides to this coin. It's like infertility, where there's the downside of being childless. You can also apply for priesthood. The interesting golden truth about inflation is that it is the only economic concept that normal people actually give a shit about. It is also a rallying factor for the old and young. The senior citizens go, "Oh, I remember the inflation of '81. Some people had to sell their kidneys just to have breakfast." And while you don't believe that, you are already thinking about how you are about to become a broke bastard. Inflation has hit a 30-year all-time high in America, and the experts are already suggesting that it is about to get worse. Too bad you have been smoking all your life, Greg. Who are you going to sell your kidneys to for a Big Mac now? Huh? The US prices for just about everything, from cars and gasoline to food and clothing, are rising at the fastest pace in decades. Overall, consumer prices rose in 2021 at the fastest in 39 years, meaning this is the worst inflation experienced by anyone not about to retire or older. But as we mentioned earlier, that is not even the problem. The problem is that experts have agreed that it will only get worse from here. Shit, it's like Titanic, but Jack and Rose died. In November, inflation rose by 6.8%, and in December, the prices of fuel, gasoline, groceries, shelter, vehicles, food, clothing, and transportation all increased. Some gas stations charged a whopping $6 for a gallon. Used cars and truck prices rose by 37% as well. But it is not just in basic amenities that inflation catches up with the average citizen. It extends to taxes as well. Experts have warned that inflation may affect your tax bill. Yup, you know how hard it is to do your taxes? Well, brace yourselves. Shit is about to get worse. The thing is, the higher the inflation gets, the more uneven its impact will be on taxes owed to the government. According to Kyle Pomerleau, a senior fellow at American Enterprise Institute, because of differences in inflation adjustments, some taxpayers will feel the impact of inflation more than others. The first inflation indexation is a technique to adjust income payments by means of a price index in order to maintain the purchasing power of the public after inflation, was enacted in 1981 after years of inflation as high as 14.82%. It was discovered that while taxpayers' income had risen with inflation, tax brackets remained fixed. As a result, people owed higher taxes due to nominal but not real increase in income. Basically, the government pretended to protect taxpayers, and it blew up in everyone's faces. In relation to our present problem, although the IRS has boosted federal income tax brackets for 2022, standard deductions, and more, other provisions remain unchanged, leading to higher levies over time. And sometimes it is against low-income earners. In places without inflation adjustment for tax brackets, some taxpayers may have higher tax burdens. So, while 41 states and the District of Columbia tax wages, 25 have at least one major unindexed tax provision, and 13 don't index any of these components. That means unlegislated tax increases every year and reduced wage growth, particularly during inflation. And really, that is still not the worst of it. According to Harris Larry at Persec Financial, while unchanged provisions may affect taxpayers during inflations, it is difficult to gauge the damage without running a tax projection because most people's returns have too many moving parts. Let's cut to the chase. Nobody completely understands what Harris Larry from PERSEC is saying, or anything the IRS puts out. The bottom line is just that taxpayers are fucked during inflations.